All right, so Brandon and I did the little switcheroo yesterday. It was actually my birthday yesterday, and I spent my birthday hopped up on pain meds in bed. So dealing with a little bit of a disc issue here in my neck, and it's having impact. So if I sound incoherent throughout the video tonight, just keep in mind that it's the drugs talking, right? And I will say it took a little longer than normal today. I had to push through. But the markets have been as flat as a pancake the last few days. That doesn't mean, though, that there aren't some moves going on that are a little interesting in terms of how they might impact our posture. So I'm going to break that down in today's video. So let's go ahead and get started. Today is Thursday, April the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500. With the market forecast indicator. The S&P literally has not gone anywhere the last so many days. Look, you can see you'll see it even better on the intraday chart, but a very, very small range. Not really moving much of anywhere. It's still got a strong bullish posture. The intermediate line still in the upper reversal zone. The long-term market sentiment line is also in the upper reversal zone. So that's strong trends. Now, granted, they both just started, right? This is the intermediate posture, which is typically, the long-term market sentiment, which is typically a 8-9 month rally up above 50 and back down below 50. That's average, right? Sometimes longer, sometimes shorter, and usually contains multiple intermediate rallies. Well, this is the first intermediate rally. That's 3 months into it now. So it's not like they're so overbought that they have to come down, but this is a very 3 months is your typical time frame on the long end of the range for an intermediate run. So the near-term line did pull back down below 50 because of this little one-day drop that we've had. The one down day that we've had in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So 10 out of 11 up days. Now, granted, the last 4 of the up days were really nothing, but the one down day brought the near-term line below 50, and actually brought the actual down day itself brought the momentum line down below 20, this little intermediate confirmation signal, and the next day brought the near-term line below 50. Now we're bouncing. So it was bounced up. It hasn't gotten up above 80 yet again, but we had a nice near-term run, and you can see how an intermediate rally takes multiple near-term rallies up above 50 and back down. So now here we go. Are we going to get a near-term rally like this? See, this looked like it was actually the beginning of the end of this intermediate run, because the near-term line, was very short run. It was bearish. We got down to a bearish low point, but then, a nice strong rally. Since then, really, since the low point of March the 8th, we've had a nice good run here off of that, and we never did turn. I mean, we got that weakness on the intermediate line, and then we got a subsequent lower intermediate low point that diverged with a higher high, a higher low up here. These are all signs. And an extreme low on the momentum line here. Near-term line also getting well into. These are all signs that the intermediate line is fading. At least its momentum is fading. It doesn't mean that we're like entering bear market. So I hope that I know a lot of people live in this binary investing world where either the market goes up, like gangbusters, or it tanks, off a cliff, and that's not the reality. The reality is, we do get, small little pullbacks like this over here, and that's probably where we're headed right here. But again, trade deal headlines continue to avoid this kind of a pullback, which is nice because this kind of a pullback leads to that kind of a rally. The problem when you don't get that kind of a pullback, in this case it was tax reform, that those were the headlines that avoided that kind of a pullback right here. We just kept going higher and higher and higher and higher and higher and higher, and that's the pullbacks you get. So that's the problem, right? If we don't get this kind of move like we saw last summer, pretty soon, and so we can, it's again headlines pushing higher, and getting us up towards 2,900, which is kind of a nice round magic number. The Dow Jones Industrial Average is still below it, so it's still little weak here. Its intermediate posture is almost weakly bearish again. Its near-term Didn't get to extreme lows like this last one did, but it did drop down to oversold and intermediate confirmation bounce. The Nasdaq Composite, of course, the strongest one, had a little bit bigger of a decline today too, but see, its near term line never did drop below 50. It stayed up and has been diverging here. And then finally the Russell 2000, which has been your weakest performer, had that nice little breakout move that then failed. Then we had a rebounded, and then today unbelievably small range today at 1579 with just 6 points of a range, a third of its average. That is this crazy small range for the Russell, and you almost got a cluster, right? We came really close to the momentum line. In fact, if it had we closed at 1600 or anywhere towards the highs, we would have got the momentum line up in the reversal zone, and we would have came close. The intermediate line still, 79.5 is just about there. The market sentiment line. So you can see small caps are catching up. It had the near-term pullback too, and it's got the dark green shading with the dark green line again. So nice little bullish pattern there. But again, see this sideways action, which actually brought the intermediate line below 50. That's the kind of pullback, right? That's what it looked like last summer. That's the kind of pullback that leads to a nice new intermediate run. Without it, we continue like we're seeing on the S&P. That's the kind of pullback we kind of need to see on the S&P and the Dow and the Nasdaq, so that we can get another 1 to 3 month rally without worrying about being so overextended. As always, a quick reminder before we look at some other charts here, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Or if you're on the desktop, down below the video, there's a red subscribe button as well. Just click on that. That will give you notifications when these videos are posted on YouTube. Also, hit the thumbs up icon that's down below the video. That tells us two things. Number one, that you got something out of the video today. Number two, that you want us to do it again tomorrow. It's a quick and easy way to give us feedback. We look at that every day, every video, to see what you're thinking, how you're thinking about our videos. We don't send you surveys, so we just look at those thumbs up. So you can do that right now if that's the case, down below the video. Also down below, comment on anything that stood out to you. What did you get out of the video today? What was something you learned, or any questions or comments that you have? Join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Really easy way to subscribe to that. Click on that. Remember, you get timestamp summaries of what we talk about in these videos there. Also, follow us on Twitter for more content in between videos, and then join our Market Outlook community that we've created on Facebook. Here's another really easy way to subscribe to our email list. Right here on the blog post for the video down below, just type in your name and email address and click that blue button. Very, very simple. You can also share this blog post across your different social media campaigns. This is what the email looks like when you get it. It's got a link to the video. There's your timestamp summaries. These are all hyperlinks, so you can click on this and it will take you, like for example, straight to the trade example there. At 27.42, and then finally it's got the clusters at the bottom, so you have to scroll down and it's got the cluster links here at the bottom of the page, at the bottom of your email. Also on this page is our calendar, and you can click on this view more to see the rest of our calendar for the month, as well as next month actually. And then above our video there's a link to go to our forums, our message board on marketscholars.com, specifically for these videos, Market Outlook videos. You can participate in there for free. There's no charge. You just have to subscribe to our site up here by clicking on this red subscribe image, and that will very easy way to subscribe to our site. And you can be able to open up any new threads or reply to anybody else's threads with questions or comments about what we discuss in these videos in the forums. Alright, so back to the charts. You can see here on the long-term chart a little bit of Harami forming here. Very small range so far for the week. Remember, again, this looks like a very neutral candle, but the reality is on the Hakinyashi it's still a pretty darn bullish candle. And we're not anywhere threatening the open to get a lower shadow, which would make it like this, a transition candle. So, again, are we going to start any kind of pullbacks? Not this week, at least not according to that. We could, but it won't be significant, right? We usually, before you get these big significant declines, even if they're multiple weeks, you usually get those transition candles here. And obviously we're not getting one of those this week. We could next week, but not this week. So that's the beauty of having a smoothed out trending candlestick like this to look at. If you look at for example, if you look at the Russell using the Hakinashis as well, you can see again, we had some transition. We had some bearish candles here. Not the most bearish because they had long upper and lower shadows on all these weeks, but they were bearish nonetheless. And then, now we're still going bullish again with this golden cross, 50-day crossing above the 200, or the 10-week crossing above the 40-week, both of those exponential moving averages. See how bullish the NASDAQ is here. And again, only a couple transition candles there, but back to some strong bullish trends. And then finally the Dow Jones Industrial Average, which is a little weaker, smaller candle, and not really getting up to new highs here. So, a tad bit of weakness there on the Dow. Not like reversal weakness, but a tad bit of weakness to be mindful of. Still no lower shadow though. So let's look at the daily charts here on the 3 green arrows. And you'll see, the S&P still easily showing 3 green arrows, but losing momentum as we kind of grind away. So if you look at this on a 2-line version here, as flat as we've been the last so many days, we're still easily above the 30-day moving average, and we're also above the rising 8-day exponential. So that's how bullish we are when you stay up above that 8-day. But you see how the MACD is falling and it's closer crossing back below its moving average. The stochastics is also below it's in the upper reversal zone, but you also see that its moving average is also in the upper reversal zone. So that kind of means that buyers, again, that moving average there, the blue line is a 5-day average closing price, and where that price is that average price of the last 5 days closes, where that is in relation to the 14-day range. That's these numbers over here on the left. And then the orange line is a 5-day simple moving average of that line. So, we're closing on average easily, in the, really, really close to the 4-week highs. And you'll see that here on this next chart. So now looking at the intraday chart, you see how sideways we've been. 1, 2, 3, 4, 5. That's the range has gone from 287 on the low end to 289 on the upper end for the last 5 days. So 2-point range, very, very small. Higher high and a higher low today, but again, not breaking out of this 2-point range that we've been in for 5 days. And it's, the 2 points closest to the high of the 4-week period, not the 2 points closest to the low. So that's, I'd much, if you're bullish, you'd much rather be up here than down here. But you see the purple line. First, the dotted line is obviously the midpoint of the 4-week range, which is not going to change until we push through to new highs. Then it will push it up higher. But the purple line is this week's Hakinyashi open. So again, unless we fall more than 5 points tomorrow, we're not going to get a lower shadow on the Hakinyashi candlestick. But because we are really starting to trend sideways, and you see how small, this is the whole week's range has only been 2 points. It's a very, very small weekly range. It's really starting to tighten up. That means next week's Hakinyashi candle is going to be really tight, because again, this open's going to move up into this area here, so it will be much easier for it to come down and close in the lower part of to form a lower shadow, form that transition candle. So something to keep an eye on. And then next week too, by the end of next week, you'll still have that low point there, but the week after that, it'll start to move up and really starting to tighten up too again, unless we get new highs to widen this out. Now, we're not too wide here. It's only about 11 points, and 14 points is where you start to say, okay, we're getting a little too wide on a bullish move, right? That 5% mark of the highs. So we're not there yet. We're not even 5% of the low point. So we can still we still have a little bit more room to the upside that we can actually move up to. And that's kind of what we talked about in our last video, at least last Friday, was there's a pullback coming, but there's still room for smaller moves or grinding moves to the upside. But man, today's range, especially on the S&P 500, especially on the Russell 2000, but even on the S&P, 1.25 points and a 5-point range over a small period of volume at 55 million. These are very, very small numbers. 1.25 points is down here. 55 million is down below these lows. You can see now how even the relative ATR is down to 0.75 point of the ATR. I mean, that's getting pretty low too. It's gotten down to about 0.6% of a percentage. 0.6% of a percentage before, and even then, when it gets there, it can continue to grind slowly higher. But you can kind of see how that's we're not going to be going up with strong moves to the upside really until you break through this resistance here. But even then, you don't have a whole lot of volume up here, so it's not going to need a big breakout move to get you up through such a resistance level, right? If you look at the volume profile over the last year, you'll see that there's very, very little volume relative to what we've passed through here, right? We had to pass through significant volume as we were, for example, when we were getting up into this area. Let's look at the year chart for January the 30th. We'll change this custom time frame to January the 30th to see what the volume profile looked like there. For this would be this year, and then that would be February the 1st of last year for the year chart. You can see, look at all the volume we had up above. We were you can see why the big move, we're getting you through this volume node here, but we had a lot of volume to get through to get to this point where we're trading right now, and this inside of there. So that's what it looks like now here, right? So we've gone through that area. We've got through all that volume with a decent run, a little bit of a pullback towards that support, a decent run to get to this point. We're filling in that vacuum that was right here, and we've got a little bit of resistance here, but it's not going to need, it wasn't nearly as big of a volume node as these were that we pushed through with these big moves. So, in my opinion, and again, take it for what it's worth, but would be susceptible to that type of fake out move where you push through because it's not very hard to, and then we start to pull back toward, and we get that intermediate pullback, right? We sucker in a lot of people thinking we're breaking out where there's not much to break out of, because it's only like one time we've touched this area and not with a lot of volume. So we'll break out above there, sucker in a lot of people, new all-time highs, and then pull back towards support. It wouldn't pull back sharply because you got a lot of support here, but you can see, your Fibonacci retracement zones, how far down where you support, where you can pull back to, just to be simply Fibonacci retracement levels and where your volume nodes would be. Finally, let's look at the volatility, and you see, as we go to new highs, the volatility is not going to new lows. So we're not breaking down below 12.5 here. We're still at 13. We're not breaking into the lower half here. So that's a little telling to me in terms of, how the market's still not really saying, okay, here we go on the trend, right? It's kind of saying, we should be bouncing up off of this, and we're not, but we're not breaking below it either. So we're kind of stuck in limbo as we're grinding at these 4-week highs. It's not a bad limbo to be in, right? Because we're pushing higher, and bullish trades are doing well, as in our classes we've had. They've been doing well here, but so it's not a bad limbo to be in, but it's not a trending limbo either. We're kind of, like I said, 2 points in the last 5 days kind of shows, what happens when you lose momentum. So there's our market outlook then, going through our normal routine. What do you think about that? There's a link popping out right there in the top right corner of your screen. Click that link. It opens up a poll where you can vote. Do you agree with that market outlook? Do you disagree with it? If you vote disagree, scroll to the bottom, comment. What do you see that suggests otherwise? Maybe you're a lot more bullish than I am, where we're kind of grinding. Maybe you're more bearish. Maybe you're expecting more of a pullback than I am. Whatever it is, feel free to share down in the comment section below what you're seeing that would suggest otherwise from what we talked about here today. All right, now let's take a look at what's driving the price action today. You can see the only things that were up today, at least on this chart here, was the dollar, high yield bonds, and preferred stocks. So long-term bonds were not. It was a kind of a risk-off kind of a day. Stocks were down, at least until the end of the day. But you see that Gold was down too. In fact, I mean, this is kind of odd to see this combination down here, but you had crude oil and emerging markets. That's not odd. But then you see gold and long-term bonds underperforming like stocks on to the downside, and that is odd. So a little bit of a pattern that you don't typically see. Excuse me. Let's take a look at the daily chart for gold and see what it's doing here. You can see, you know, the big down day it's had. It's got a little bit of a descending triangle forming here. Similar to the dollar, right? The dollar's kind of got a resistance level at 98 that it's not quite getting above, and it's getting progressively higher lows. Here's the chart. Sorry, 1 second here. There we go. So you got that 90, well, 97.5, but getting above 98 will be significant. So you can see the opposite of that pattern here. So getting below this, say 1270 area, which would be the 50% Fibonacci retracement, that would be your significant move there. Until then, it's just noise, right? In fact, if you take a look at the trend strength on the daily chart, you can see, I mean, it's just noise. You see how there's no trend. The trend noise balance is all the way down to 0. It has to be above 50 for there to be a trend. And then this tells you which direction, obviously bullish or bearish, and there's no trend whatsoever, and we haven't had a trend for a while here. And the same thing if you look at the dollar index with the same indicator, no trend. We haven't had a trend on the dollar for a while either. It's been very noisy, very sideways, due for a breakout at some point. I mean, if you were to kind of show a little bit longer term here to kind of get an idea, I mean, it had some periods of sideways moves. You know, there was a little bit of a sideways move, then we had a big bullish trend, then we had some sideways action, then another bullish trend, and then we've really been sideways for really, I mean, there's little fits and spurts here, but really since the end of 2018, we're going on, you know, about 4 or 5 plus months without a trend on the dollar. So it's kind of setting up for a breakout move, a trend to develop in either direction, right? Either up or down. You can see the trend going into it's up. And so like I said, 98, that's your key level if we're going to break out to a trend back to the upside. This is what it looks like on a weekly basis to kind of show you that time frame. Again, no trend, and this one doesn't stay trendless for as long. And there's been some time over here, you had quite a few weeks without a trend before you got that last bullish move, and then we had the big bearish trend really quickly, and then some noise, and then another big bearish move, and then noise, and then this big bullish move. So right now we're at noise even on the weekly chart as well. So until you really break out one way or the other, you know, consider the fact that the dollar and gold are really, really noisy right now. And not the case for the yield, right? Remember, bonds were down today, so bond yields went up to 2.5%, but maintaining a moderate bearish trend here on the weekly chart. On the daily chart, go back to the daily chart here, and you can see a pretty moderate daily trend too. So, you know, yeah, we bounced up today, but put that move that we had today in some context here. We are still mired in a very strong bearish trend, and when we haven't finished that trend yet. In fact, if you look at it again on the weekly chart here, and then look at the Hakinyashis for the 10-year note, then you can see we've got a couple transition candles. We don't have a good bullish, where we haven't started a bullish trend quite yet. And if we do, I wouldn't expect it to last more than just a few weeks to get up into this 2.7 area, maybe up to 2.75 before it meets up with that long-term resistance at the 200-day moving average, and then continues the downward trend, because the odds of a rate hikes are just nil, right? And there continues to be odd, and not as high. The odds for a rate cut are down, and so that's helping lift things. But you see, from an economic surprise perspective, we continue to be very weak. Inflation has been a hot topic the last couple of days. You actually see inflation on a year-over-year basis rising. First here on the CPI from yesterday, on a headline basis, not on the core level, but on the headline basis, rising. We've seen a 1-month rise before during this decline, and then the same thing on the PPI today. we had the headline figure on a year-over-year basis rise. And again, we've seen a 1 month spike since we peaked on this, but the core is still falling. You take a look here at the expectations, inflation expectations, which is not updated as of yet, but you see how, I mean, we were down to 1.94%, and we've rallied here all the way up to yesterday. It's been updated to 2.05. So not getting above 2.06 yet. That kind of is a little bit of a short-term peak we have. So we're going to keep an eye on those inflation expectations, because as those rise, then you'll see yields rise along with it. As you take a look at the foreign markets, you can see we're getting some pullbacks here in some of these other areas. China's pulling back to a rising move. They're all rising moving averages except for Brazil, which has a falling moving average, and it's shaded pink and is almost below 50. Korea is got a yellow moving average, so it hasn't turned up higher. It's trading up above it. Everything else you see, dark green shading, we're all above 50 in all of these, and dark green lines, so bullish trends. But some of them are just pulling back a little bit more than others. The developed markets aren't pulling back nearly as much as what we see like in Russia today, and what we've seen in China over the last few days, as well as in Japan. From a sector rotation standpoint, interesting move today in healthcare. In fact, healthcare now is got a pink shading. In fact, there's two sectors with pink shadings, industrials and healthcare. Neither one of them below 50, so you don't have the dark pink shading yet. And neither one of them are showing red lines. The industrials is showing a yellow line. It's above a falling moving average. And then the healthcare, you can see, is below falling, so it will turn red tomorrow. It's kind of a pretty decent sized move in healthcare. We've actually got a few bearish trades from our directional option strategies class in that sector. We've been a little bit weak on healthcare, and you see its move that it's had today. All the other sectors, you see how bullish they are, except for financials is flat, yellow line. Utilities is flat with a yellow line. All the rest of them are rising pretty sharply. Technology, real estate, communication services, materials, staples, discretionary. Look how strong these moves are. Energy is kind of lagging, but still at least bullish. But this it's got a smaller number along with consumer staples in terms of its 3-month returns, kind of matching what we're seeing in financials as weak as it's been, and matching what it's seen in utilities. Look at that 20% 3-month return though for technology. Nice, good, strong move there. Real estate's still holding strong, but discretionary up 12%, communication services up 10%. So you see very strong very strong moves in these cyclical areas. So for our trade example today, United Healthcare really dropped sharply, and it's got earnings coming up here pretty soon. But you see the big move it has had. It's got a little bit of a declining trend. It had a sideways trend. Again, if you look at the trend strength here, you can see on a weekly chart, it's looking more bearish. Right? You got the death cross, you got the retest of the 200. We're bouncing down, but look on the daily chart for this, and you see we have the beginnings of a weak bearish trend, close to a moderate. Like we're below -1, we're above 50. The next level would be to get below -2 and then get above 65, and then 80 and -5. So we got the beginnings on the weekly and the daily chart of at least a weak bearish trend developing right now as we speak. Obviously, 3 dark pink shading here on the market forecast today, the intermediate line turning down below 50, and a red line, and then of course we did get 3 green arrows on a downward trend, though led you to a new set of 3 red arrows here today, with a spike in volume obviously to the downside. You take a look at like its Bollinger Bands, and you see breaking outside of this range of volume, the 70% range. Not a lot of volume down here in the last year, and if you were to go further out and look, say over the last 5 years worth of volume, let's do 2 years. You can see our next stage of volumes down here around 220. So you can get a pretty decent move down to 220 without hitting another major level of volume here. Remember, you have earnings coming up here next week on the 16th. And then finally, and also too on the Bollinger Bands, we did fall below the lower Bollinger Bands with a relatively low Bollinger Band width. And then you see on the DMI indicators spiking above positive 25, the negative line spiking above 25, the positive line already below 20. So nice bearish pattern on the DMI. And as I showed you on the long-term chart, you got that divergence, and then you look at the really short-term chart, and you see how, what that breakout looks like, breaking the new 4-week lows. Today really kind of breaking out here. So we can be a little bit bearish here, but we got earnings. So I wanted to show you a long vertical spread relative to a short vertical spread. So typically we do short vertical spreads are higher probability in nature, right? And the typical setup, if you're going for that 30% return on risk, you're essentially risking on a max loss basis $3 to make one on average. Now granted, we usually only like to lose what you're trying to make, but you're typically risking on a max gain to max loss basis $3 to make one. So for example, if I wanted to make, as you can see, my maximum gain here is 738 on this long vertical spread, where I buy the close to at the money put at 230 here, and then sell this 220, where I think that next layer of support is on the volume basis. And of course, you might, depending upon where you get filled in, you probably get filled in right around this area. You can see that my gain is $726, which is that $1,000 minus the cost of the depth of the spread. It's a cash trade. For me to get that kind of reward on a short vertical spread, $726, it would take me about a couple $1,000, risking $3 to make one on a max loss basis. Well, instead of having a couple $1,000 max loss, I only have a $200 max loss. It is a speculative trade. It's got low probability, but considering the trend and considering the earnings, and you can see 220 is actually at current volatility levels with that earnings coming up. 220 is well within one standard deviation between now and that May expiration. In fact, we can go lower than that. So there's plenty of the market's priced in to make that move. In fact, if you were doing if you were selling that delta, that 20 delta for like an iron condor, then that would be your low point, right? So here we are targeting that low point on any move to the downside. If it goes up and shoots back up as quickly as it shot down today, then we know the most I can lose is $274. If I were doing a short vertical spread targeting that kind of return, I'd be willing to lose $726. So the fact that at most I can lose $274, I've got a nice little setup for a speculative trade. Lower probability, and that's when you get good reward risk ratios like you got here, almost 3 to 1. When you've got good reward risk ratios, you're going to give up probability, but that's okay because I've got such a good ratio. I can give it the time and see if the probabilities work out, and that the technicals, which are very bearish for the stock today, work themselves out. All right, well, that wraps us up for today. As always, thank you very much for watching. Now I want to hear from you. So use that link that's popping out up there. Let's go to our Market Outlook forums. Any questions or comments you have, open up a new thread. Reply to anybody else's thread. If you have any questions or comments on anything I didn't discuss today, that you just want to open up a new discussion topic that relates to what we typically talk about, then open up a new thread. It doesn't have to be what we talk about in these videos, and you can be able to get a discussion going with other market scholars that watch these videos day in and day out. As always, thank you very much for watching. Have a great rest of your evening, everybody, and we'll see you all tomorrow.